Sonal Varma, India economist. Nomura joins in from Singapore to talk about her expectations ahead of the credit policy review. Sonal, great to have you on the show. Thanks very much for taking on the time. First up, what do you expect from the policy meet?
Well, we are not expecting a rate cut primarily because, yes, headline inflation has been low, but core inflation is still quite elevated. Growth for now seems to be quite steady, and the fiscal risks have materialized, so the budget has been expansionary at the margin. So the neutral stance essentially acknowledges that the risks are more balanced and sort of more data dependence, but no rate cut in terms of our expectation.
There are strong arguments for a status quo given risks on the fiscal side as well as high core CPI. However, do you think that today is probably the only window for the RBI to cut rates before elections, given that they won't perhaps arrest upside risks to inflation, or they would be stepping back on that?
I think, through the course of 2019, there will be ample opportunities. You're right that headline inflation will pick up as we go through 2019. But on average, we do think it's going to stay sub 4%. The main sort of thorn, so to speak, is really core inflation. And if we do see signs of core inflation moderating and converging towards the medium term, let's say 4.5% kind of a range, then I think we would still have a fairly good macro backdrop in order to essentially deliver a cut. So I don't think this is the only window. I think there'll be ample opportunities as we go down the line.
Right. This will be Governor Shaktikanta Das's first policy. What will you watch out for in terms of commentary?
I think, the first thing is this entire divergence between headline and core and, how monetary policy reacts to this, because that is obviously causing a lot of divergence in opinions and views. So how the RBI sees it will be quite important. Second, in terms of their assessment of why core inflation has been so high and whether it has any implication for the macro policy, or is it more a data quirk? Third, in terms of the real rate framework, the guidance so far has been in the 1.5% to 2% range on the real rate framework. The expectation for 2019 or over the next 12 months, the inflation outlook is that it's going to be at best an average of 4%. So where do they stand on the real rate framework, and what does it imply therefore on forward-looking policy? And fourth, in terms of the liquidity assessment, the tools that they intend to use to manage this liquidity going forward, and if there are any sector-specific liquidity measures that need to be taken. I think, these would be some of the main things we would be watching out for.
Okay, your view on the liquidity situation. Although liquidity has improved, overall, do you think that it's been managed well?
Well, besides OMO in terms of direct liquidity injection, we don't expect anything at this stage. So it's primarily OMO. I think the liquidity situation is probably more sector specific, where there are specific sectors where the spreads have widened because of the perceived credit risk in that particular sector. Perhaps a sector-specific liquidity measure is something that the RBI could consider, but overall, I think primarily through OMO purchases is how we think the liquidity situation is going to be handled.
Right. Is CRR an answer to improve overall flow of money to the economy, be it with support banks and support credit growth, is also support NBFCs which are struggling?
Well, CRR is actually quite a blunt instrument, and if we need to inject substantial amount of money across the board, then it's the right instrument. Having made the transition, given the significant OMOs, the liquidity situation today is much better than it was 3-4 months back. So per se, a blunt instrument like a CRR cut is not necessary. also at 4% CRR is already quite low. So I do think that there are other tools that can be used to inject liquidity right now rather than through a CRR cut.
Right, growth has been recovering at a slow pace. What is your view on overall growth going ahead? Also, how do you see global slowdown impacting India?
I mean, over the next 12 months or so, we do think India will enter a cyclical slowdown. The weak global demand as well as the political uncertainty that we have domestically essentially imply that both the exports and the investment sides will see a moderation from where we are right now. The counter that we have seen in India is essentially the expansionary fiscal policy, which is more geared towards consumption, and the lower oil prices, which is again positive for consumption. So our overall assessment is that growth over the next 12 months is going to be in the 6.5% to 7% range, and which is a slowdown from 2018. And the composition of growth is also going to change towards consumption and a moderation in both investments as well as export related sectors.
Okay, could you also help us understand your overall view on fiscal deficit? The new government may probably have less room to maneuver on the expenditure side. Hence, how do you see the fiscal deficit to impact the economy?
I mean, on the fiscal side, essentially there are two issues. One is that the pace of consolidation itself has been paused, and essentially that implies that there is a positive growth impetus coming from fiscal policy. And second is the composition of our spending, which is now moving towards more consumption with a slowdown in the total capex growth. So if we put the two together, then, like I said, overall it's a positive growth impulse, but more consumption oriented, and the total size of borrowing of the public sector as a whole, whether it's center, state or public sector enterprises, is now quite substantial. So I think there's a risk that this ends up crowding out private investment. The other thing we need to keep in mind is that the farm package that has been announced, the implementation of that is going to see some challenges because, having computerized, accurate, up-to-date land records which are linked to bank accounts across all states, may be administratively more challenging. And therefore, while the government has allocated amount and some of this transfer, in fact, a good proportion of this transfer will happen, I think the risk is that the actual spending in terms of this income support scheme might end up being lesser than what the budget has assumed. But nevertheless, it's of course a positive consumption impulse nevertheless.
Okay, that's good to know, but bond yields have also risen post the interim budget. What's your view on rates, both at the shorter end and the long end of the curve?
I think on the monetary policy side, broadly our view is that there will be disappointment on the growth front, and therefore the expectation of a potential rate cut in the future very much remains, and that essentially will keep the front end anchored. But on the fiscal side, clearly the supply demand equation is a bit of a challenge as we get into FY20. Both in terms of the extra borrowing that the government is doing, as well as in terms of the capacity and the need for the Reserve Bank to do OMO into FY20, and that could keep the longer end a bit on the higher side. So overall, our expectation is more of a steeper curve in this environment.
The rupee has been weaker in 2019. What is your view on the currency?
Well, the global backdrop, of course, per se has become a bit more supportive for the current account deficit countries given the more dovish shift in Fed stance. But I think for India, given we still have the political uncertainty into the elections, we do think the flows will be on the lower side, and that could cause some depreciation of the rupee into the elections. Post-elections, I think if we do have clarity one way or the other on the political front, then I think that should be a positive, and therefore we could end up seeing more of a year of two halves for the rupee, with pressure a bit towards the depreciation front into the elections and more appreciation post-elections.
Okay, Sonal, we leave it at that. Thanks very much for joining us with your perspective on the market.